Hey guys, welcome back to the channel. If you were watching yesterday, you knew that I came in today positioned 60% net short, and that's paid off really well today with markets dropping across the board. A lot of risk coming out, but is this a reversal? We do have a lower low, a lower high, lower open, lower close, but before we get back to the SP 500, let's look at all the other charts first. And as a reminder, this is not financial advice, and be sure to stay to the end where I'll give you how I am positioned going over the weekend into next week. So we had NASDAQ of 1.7% today. All the indices formed a very similar candle formation, opening up lower, and just Dow didn't do too bad. It was only down 0.4%. It was more the NASDAQ coming off. We got really overbought yesterday, if you remember, after the mega cap tech earnings. But that's all kind of a bit of hot airs come out today, especially in international across the board. Even China was down 2.4%. And I think with the China reopening, that sparked commodities. So commodities in China have been kind of trading in a little bit of a lockstep, and they both came off hard today. Volatility, kind of the same as yesterday. Stocks were up yesterday, so was volatility, and stocks were down today, so was volatility. So normally an inverse relationship, but it's kind of just tracking sideways here around 18.3. And considering what was supposed to be a real eventful week with the Fed and mega cap tech earnings and jobs data that just came out, we didn't really get the rally in volatility, and especially we had a big up move too. So in the underlying, realized volatility has been quite elevated, but implied volatility is continuing to stay low. And back to jobs data, the jobs report came in much better than expected. US economy added over 500,000 new jobs versus the 188,000 expected. So that has made the markets price in a higher chance that the Fed does keep its foot on the gas and keep increasing rates. And we saw that today in the 2-year popping up quite strongly up to 4.29%. And same with the 10-year, quite the rally in the 10-year as well, off this support zone that we've been watching. So with the jobs market so strong, Jay Powell's more inclined to keep erring on the side of caution with getting on top of inflation, and he's going to stay on target to get rates to over 5% this year, kind of ignoring what the market's kind of egging him on to do, is to start talking more about pausing or even pivoting and getting more dovish. But with the jobs market so strong, I doubt he will keep his foot on the gas until inflation well and truly does come under control. However, if the jobs market started weakening with this higher rates coming through, then he would probably start offering up some dovish commentary and be open to the possibility of pausing slower, and if it got bad enough, even pivoting. But for now, that doesn't look like it, and I think that's why we've seen the move that we have in markets today. Amount of stocks, S&P stocks above their 20-day average fell to 66%, and kind of looks to be rolling over. Same with the one above the 50-day. However, structurally, we've still broken out with the amount of stocks above their 200-day average, even broken up to the levels of when the bear market started. So, and with the strong January, I mean, there's two theories out there. This could be a bit of a bounce after a heavy tax loss selling in Q4 and last year, because we have seen a lot of the beaten down stocks bounce pretty hard. Or this could be the January effect telling us that we're in for a big year. So there's a lot of conflicting big indicators about what we're set up for this year. So it'll be interesting to see how it finishes. Over to the put-call ratio, that's still low. Not many people buying insurance at the moment at 0.91. So there's not a whole lot of fear out there in the market just yet. I would say we're still at elevated greed levels. Cyclical sectors had a cooler today. Lower low, lower high. High beta came off, but although not much. So couldn't call this a reversal just yet in the cyclical growth rotation trade. We still look like to be in a strong, kind of parabolic move. Although we have gotten really stretched here, so I mean this could be a little short-term top, and we do a 50% retracement. But it's just a little bit too early to call that just yet. I mean, we could still keep tracking higher for another week or so. So when we're walking the line of the buy-sell band here, it's hard to tell when is going to stop unless we have a big kind of blow-off candle. The yield curve actually fell 8% today with the move up in rates. And if we go out to a monthly chart, if we go out even to a 6-month chart, we can see we're now at the deepest it's ever been inverted. This is going back to the late 80s. So for how long we've been inverted and how deep we are, it's the market saying there's a recession coming. So the market's sure there's a recession coming and pricing in lower rates, but Jay Powell's saying, no, I'm going to get on top of inflation because the jobs market's still fine. So we're coming down to, at 0.76, we're coming down to the all-time lows at 0.84 here. So that's very bearish for the economy coming up. And with that, we had treasuries off 1.5%, and high yield looks to have gone back down under this resistance line. It's one we've been watching for a while here. And it does look like we've put in an inverted head and shoulders bottom. However, we really need to clear this line before we can start confirming that bottom and calling it a new uptrend. And this would be, bullish sentiment for risk assets. But right now, it looks to have made a bit of a reversal pattern there and gone back down under. Dollar has popped up as you expect with those higher rates. Looks like to have bounced off our support zone. And euro with that has looked like it's rolled over a little bit, still above its 50 bar, and yen dollar yen has popped up as you'd expect as well. Bitcoin just seems to be sitting up there, not too much action going on there, and commodities really came off hard today. Commodity index down 2.5%, although we are approaching this support zone that we've had penciled in here for quite a while. So with China reopening and the weaker dollar, one could expect this to hold, although the economy is the inverted yield curve is predicting a weaker economy that could affect, that will affect commodity demand and pricing. So this looks like to be a bit of a critical level here in commodities. We're obviously been in this uptrend for a couple of years now, and if it were to break through the support level, you could say that this would be then a lower high, and that would be a confirmed downtrend. However, if we were to bounce off this, we could say we're still in an uptrend. So it'll be interesting to see what commodities do here over the upcoming week or so to see whether this level holds. And Dr. Copper off hard today and it's just closed below its 50-day VWAP, and that's one we've watched closely as a leading indicator. And with that bearish engulfing, and this looks like to be a little bit of a top now that is confirmed. So it'll be interesting to see whether we hold this level here and bounce off a 50% retracement of this move, or does this roll over with China and commodities as well. If looking on the 3-day chart here, so kind of we could almost draw a trend line up here. That'll kind of be the one we'll watch for Dr. Copper. So it's obviously broken this parabolic uptrend as well and closed below its 50-day VWAP on pretty strong volume, and would have caught a few people long. This big gap down and hold, so that was quite a big move. Same with silver as well, and oil. A lot of bearish breadth in the commodity complex here. And natty gas, we're still playing our long mean reversion trade here. So stay subscribed and tuned into the channel, and we'll keep you updated on this trade. But basically, we're going to give it plenty of wiggle room. We're going to even give a stop down here at 632. and we're going for a target of 13.45. So be sure to stay watching that one, and we'll keep you updated on that every day. Agriculture was the best performing sector in commodities, just came off a little bit. And uranium came off hard as well on volume. Big bearish Marubozu candle there. ARC came off on volume. It'll be interesting to see whether if we can break through Wednesday's high, I think that'll be bearish and we could retrace back. Industrial's kind of just holding up there as our transports and energy, which was surprising given how hard oil and the rest of the commodity complex came off. So the energy stocks actually held up. Materials came off a bit. Clean energy came off 2.5. Gold miners came off 4.4, as you'd expect with a decrease in gold. Home builders still very elevated and quite disconnected from the fundamentals in our opinion, and we can see a bit of bearish seasonality coming into the sector as well. Real estate off a bit. Financials just kind of sitting up there at the top of their resistance, a bit flat. Communications came off a bit. There was Meta that sent it soaring yesterday, and discretionary came off pretty hard, 3%. That'll be Amazon responsible for a lot of that move. So quite a bit of volume today, like yesterday, and retail really elevated, and it's come off a bit. Semis sitting up there in the resistance, and the defensive sectors held up the best today, but still kind of bearish chart patterns on them all: healthcare, staples, and utilities. BlackRock barometer seems to have rejected this level up here. Looks like a bit of an inverted hammer or hanging man, and it's fallen back. Apple kind of bucked the trend today and was put on a really strong showing, up 2.4%. However, Microsoft was off 2.3%. Amazon, the big loser today, down 8.4% after its earnings yesterday. So came in a lot worse than expected on EPS, and the market just didn't like that at all. Same with Google. Google's off a bit hard at 2.7%. Meta not too bad. The semis were off a bit. Barber was off 3%, and Tesla holding strong. Hit our 195 target that we had pinned there for a while, and seems to be holding that strong up there. Meme stocks came off today, as you'd expect. And also active today was Ford, whose earnings came in much worse than expected. Stock fell 7%. Although Ryan Cohen, the meme stock king, came in and has taken a stake in Nordstrom, which sent the shares up 25%. Okay, so looking at all that, what are we thinking going into the weekend? So we're overbought up here. It looks like this could be a short-term reversal. If you look on the NASDAQ as well, we just got so overbought. You can see the whole candle was above the buy-sell band, which is really unusual and usually a sign of really extreme overbought condition. And then we've had a lower low, lower high today, and we even finished below yesterday's low. So that you could be considered a bearish formation. And we have some bearish seasonality coming in over the next 7 days as well. I just couldn't find a decent long setup today. I actually increased my positioning from 60% net short to 80% net short. And that's how I'm going into next week. And we'll be seeing what's going to happen with price next week and how that'll affect the positioning. So that pretty much wraps it up for the week. Thanks for tuning in and watching. Make sure you hit the subscribe button if you haven't already, so you can stay up to date with these daily videos. And if you haven't already, we'll just show you our microcap strategy. I had a few people asking us about this. So if you're not aware what Collective 2 is, it's an online strategy marketplace where you can follow strategy developers and operators like us, and you can get real-time alerts or have that automatically traded in your IB account. And the cost for our strategy is $60 a month, and we're up just under 30% so far this year. And that's, you might be thinking, oh, that's some big concentrated lucky bet with leverage. Not at all. This is a portfolio of 20 stocks with no leverage. So each stock we have 5% of the portfolio in. So far we're tracking with on a Sharpe ratio of 4.5. So I'm kind of surprised we don't have more people sign up for this. But I mean, I don't know. Maybe a lot of people are up more than 30% so far this year. We're not even 5 weeks in, and we're up 30% already. So that's looking good for this year. I mean, if we do have a good up year in the market this year, I'd expect this microcap strategy to absolutely outperform the market by a significant margin as well. So I'll put the link below this video in the description if you want to go check it out. I'll throw in a coupon code there as well, so you can get 25% off your first month. And basically, when you sign up, you'll get we need to do a couple of trades a month in this portfolio, so you'll get a real-time alert to your email or app or whatever you want, telling you of all the trades that we've done and what current positions we've got open. And you can pay a little bit extra to Collective 2 to have the strategy automatically traded in your IB account if you want. So be sure to check that out. Maybe if you're already doing higher than 30% return this year, then obviously you don't need that. You're already killing it. But if you haven't returned 30% so far this year, then go check it out, and maybe you'll do better than the market as well. All right, thanks guys. We'll see you Monday afternoon. Have a great weekend.